Hello and welcome. I have with me today Atul Suri, founder and portfolio manager at Marathon Trends. Atul has over 3 decades of experience, so has seen multiple market cycles, and he's put together a very, very unique strategy for managing equity portfolios, which uses a combination of fundamental analysis as well as trend following through charts. Atul, such a great thing to have you with us.
Thank you.
So now, before we get started on the portfolio, let's talk about your experience. 3 decades. So you've pretty much been there, seen all of what India has had to offer.
So it made me feel like a dinosaur.
So let's start with how it is that you built up your capabilities.
Yeah. So I was doing my CA, and doing CA articles can be very boring. Those green ticks, innumerable. So I had a friend who had joined a stockbroker in research. Now, mind you, 1991, 92, research was hardly there in Indian markets, especially Indian brokers hardly did research. And this guy was actually one of the forefathers of research in India, Parag Parekh. And of course, the PPFS, now, was not there. At that stage, he was just a stockbroker. And he was among the first people to start fundamental research. And I was a part of that team. So I was actually very, very fortunate. And to add to that, you had the Harshad Mehta bull market. And we used to get, my salary was 1,300 rupees, okay? So at best, I would spend 300. I would save 1,000 because I had nobody to give that money to. And I bought a stock called ACC. Now, if you have gone and seen the movie, the famous Harshad Mehta movie, you realize that ACC was the flag bearer.
Correct.
And suddenly, I made a lot of money. And one day, I remember that I had sold some stock. And Parag Bhai told me that, Atul, instead of investing in a stock, you should invest this in education.
So profound.
Very. And I really thank him for that line because with that money, I actually funded my education. I did a master's overseas. So can you imagine the power of a trend I felt in my life, in my first investment? And that is why if you ask me, 30 years later also, all I do is trend investing and trend following, because over the years, over cycles, I've actually understood the power of markets, power of trends, and what I always do is look for stocks like that.
Right.
Your early influences life are very impressionable. So that was my first impression. Went to Australia, did a master's in international banking. So I learned fundamentals of what I would say in a theoretical way, the textbook style of it. Came back, joined a broker again. I was at that stage, AMCs were very few and far in between, Birla Sun Life.
Right.
And I saw the second big bull market of my life. This was the IT bull market. We also call it the Ketan Parekh bull run. And since I had studied abroad, I understood technology. So here again, to some extent, I would say I got lucky. I got my clients into a stock called Wipro. And Wipro did extremely well. In fact, Azim Premji, I remember, became the richest man in the world for a few weeks. And it was fantastic. I mean, I just felt top of the world. I'd done 10 years in the market, 91 to almost like 2000. And the clients loved me. There was a lot of wealth. And it always feels good when clients make money. But what happened when the Y2K bubble burst in early 2000? I saw money that was made over 2 years evaporate in 2 weeks. Because the markets used to go into circuit at those stages. So these stocks used to have 88% circuits. It was a different market, but it was very, very painful. Yeah. And then I realized that, hey, I've spent 10 years in the market. The only thing I know is what to buy. Actually, I don't know what to sell. And it got me pretty shaken because, to see clients lose money is never enjoyable. It is very, very painful. So I realized that, by the time we realized that the IT story is over, or that broker downgrades came, or we met companies, quarterly numbers, the market had done its job. The market was too fast. And I thought that, if I have the tools or I continue using the tools I have, I don't think there's any way I can exit. So to exit, I got into some quantitative work. And I found that very interesting. And that's where I got introduced to this whole concept of trend following that you mentioned as a style. Most people think as technicals and charts as what you see on television, 5 stocks a day. It's not that. It is much more evolved than that. And trend following is actually a style and a method. Then in 2003, I got introduced to a large market player named Rakesh Jhunjhunwala. At that stage, Rakesh ji was not so famous or not the billionaire that he's known to be. But I was very fortunate that I saw that journey of, $1 billion being created in one stock, Titan. And what I liked about Rakesh ji, and I joined him in 2007, was that his unique ability to combine fundamentals. He had very good understanding of fundamentals, but with the market trends.
Right.
And that was my style also of trend following. So there was a lot to learn. I joined him in Rare for 10 years because I consider him the master of the trend. He has that famous line, "Vadhare vadhare levanu, ghatade ghatade vechvanu," which is classic of what trend following is. That is really 101. And I saw that happen in multiple stocks. So people know Rakesh ji for Titan or maybe for a Lupin or a Crisil or some other stocks. But for each one of them, he's also had his failures.
Right.
But the beauty was that he was able to sell his losses and ride his profits.
Right.
And that is what really created the wealth that there is. So that's why I call him the master of the trend. And his strength, most people think, people asked him, how did you identify Titan? The interesting part is the skill was not in identifying Titan. The skill was the way he navigated it. Because when he bought Titan, it was a watch company, right? But he made money, or that company made money in the jewelry, in the whole Tanishq story.
Yes.
So the beauty is the way he pyramided and the way he held on to the position. So that's why I realized that ultimately he was a great mentor to have. I worked with him till 2017. Then I applied for a PMS license, but we were still advisors to Rare. So we just did PMS with just for a few close family and friends. But in 2022, unfortunately, he passed away and the time to peel off had come. So we actually came out with our first major open public offering, which is the trend following PMS, and where you guys are my first big partners with exclusivity.
Sure. Now, just to carry forward that journey and to dive a little bit into the intricacies.
Right.
So there is fundamentals.
Right.
Obviously, there are a few factors which guide you.
Sure.
And there is this trend following, which
Sure.
is charts
Sure,
and
sure,
a few
sure.
strengths, weaknesses.
Sure.
What are those key elements that go into these portfolio construction tools?
Right. So as I said that, I gave you that line in Gujarati. If I convert it into English, it is simple: buy strength, sell weakness. So if I were to summarize my 32 years experience, my philosophy, it's just 5 words: buy strength, sell weakness. But what is buy strength? So buy strength, we realized over the years, again through trial and error, that ultimately what drives stock prices are fundamentals. Yes. Sometimes stock prices may move up without fundamentals, but it always ends badly.
Yeah.
And those are stocks we definitely don't want to be in. So the first thing is we will never, ever compromise on stocks that have good earnings. So not only do you need good historical earnings, you also need a good momentum in earnings. Once you get that, you've done your basic premise. Just to put it figuratively, like we have over 2,000 stocks in the NSE, but the number of stocks that actually qualify in our things would be hardly less than 200.
Right.
So what you've done is you've eliminated 1,800 stocks which are not backed by earnings. And as I said, the beauty is that we don't create very large portfolios. We create a 20 stock portfolio. So even in that, I have to be able to show strength in price movements. So we've seen strength in earnings, we have to see strength in prices. And to study price strength, what we do is we do a lot of quantitative work. We look at 3 parameters, which is basically longevity of trend. It's not stocks that just go up for a week, 10 days and everyone's stock. You should have stocks that are in a beautiful 45-degree angle in simplicity.
So not simple momentum.
No, not at all. Momentum has to be qualified with volatility.
Correct.
I definitely want momentum, but I will again not compromise on volatility. Very high volatile stocks are good to talk about, good to look at on television, but horrible to invest in. Because when stocks are very volatile, by human nature, I will land up buying at the top and selling at the bottom.
True.
So I need, as I said, I love 45-degree angles. I don't like 90-degree angles. So the fact is that that is what we look as in strength. That is strength in earnings,
right,
which drives strength in prices. And while selling, which is the more important part, the more difficult part, which I learned way back in 2000, that we only read half the textbook. The second half of the textbook is when to sell. And I think that is a more difficult thing because it also brings in a lot of emotional.
Yes.
Someone tells you to buy, people are very quick. The moment I tell you to sell, two things happen. Okay, if the stock is making money, oh, so it's feeling good, you like the stock. If I sell it and what if the stock price goes up, you feel it's gone out of your pocket.
Yes.
The fear of missing out. The second is that very often, half the time, more than half the time, we will also exit at losses.
Yes.
Now, when we sell at a loss, we realize nobody likes to take a loss. You think that, oh, what if I sell? And then the stock bounces back.
Correct.
So the emotion we identified is called fear of missing out, FOMO. So the fact is that the fear of missing out is what stops us from understanding that it is very important to be able to sell. Because every cycle, you will realize you get sucked in, and those leaders then ultimately you land up giving all the things. So ultimately it's about buying strength, Selling weakness is just the opposite in that you will find that the rate of earnings actually starts declining, and you will see prices making breakdowns. Now, how do you see prices make down? Of course, we use quantitative measures, etc. But in all simplicity, I tell people say where to exit. I'm talking about long-term investors. I said there are two principles. One is take 52-week low. It is as simple as that. It's a mathematical number. Some people say is 5% right, 10%, 20%. Nothing has a perfect answer. So I said for all its simplicity, take 52-week low. If you have a little more understanding, there's something called the Dow theory.
Yes.
Which is that when stocks are going up, they make higher bottoms, higher tops. And stocks that are coming down make lower bottoms, lower tops. So even if you imbibe that into your life, you are a star. You will never get caught. The challenge is that you should be able to overcome the FOMO factor.
Yes.
So this is really buying strength, selling weakness. As I said, buying strength, fundamental stocks, along with good volatility-linked momentum. And selling is just the opposite. The earnings starts deaccelerating and the prices start doing this.
Right.
And when you do this as a process, you will realize that in every cycle, you realize that you do get leadership in your portfolio. And if you keep doing it in a disciplined way, that is for us what trend following is. That's what I have learned from my mentors, and that's the only thing I do.
Very, very interesting. Now, when it comes to portfolio sizing, you mentioned 20 stocks.
Right.
How is it that you go about allocating?
Right.
And from there, then, how do you exercise this discipline of selling?
Right. So as I think that, as portfolio managers, we need to have a differentiated approach to even money management apart from this. We have about 20 stocks, which is a good 5% equal weight allocation. So we don't really have this high conviction, low conviction things, because I personally find that there's no need to have low conviction bets in my portfolio. Right. I really feel that I should be committed to what I do. So we will always have about 20 around stocks. We have a good 4 to 5% kind of allocation per stock. So it's a serious position. If any stock moves, the needle really moves, number one. Number two is that when markets actually run away, a lot of stocks trend and they become very large weights. It is very nice when the stocks are going higher. The large weights actually bring out a jump in your portfolio. But every stock has a journey, and the journey is not infinite.
True.
So when these stocks correct, and if they become overtly sized in your portfolio, you'll realize that the drawdowns can be paid for you. As an individual investor, you can have outsized weightages because you are not answerable on a month-on-month basis. But we are in the asset management business, so that is the reality of life. A big reality I learned in the last 3 to 4 years. That the fact is that you need to be able to manage risk through weightages.
Sure.
So that is something that we do basically. But the more important thing is that we are also sector agnostic and we are also market cap agnostic. Why I think this is an edge, and more so in the kind of structures that we have, which is a PMS or a AIF kind of structure, is because benchmarking is a reality. And you will find that with time, increasingly, people are finding a lot of difficulty in beating the benchmark.
Yes.
The reason is that first and foremost, the benchmark itself is the ultimating trend following structure, if you ask me.
Very true.
Because what does a benchmark do? What it does is it rewards winners. If a stock does well, the market cap goes up, the stock comes into your benchmark, Nifty 50. And in case the stock doesn't do well and the price goes down, it gets eliminated. So strength gets added and weakness exits. So I say the ultimate trend following portfolio actually is the construction of the index. So if I start doing the same weights as there is, I really have a no chance.
True. True.
So for me, I have to be agnostic to sector weightages. I have to be agnostic to market caps. And I have to actually be like the wind. I have to be able to flow. It was very often, very nicely put to me by Rakesh ji that he's saying that ultimately you can make a very beautiful sailboat. But the sailboat should also have sense of where the wind is.
True.
Because you can have a beautiful boat lying in the middle of the ocean if the winds are not with you. That sailboat construction is the fundamental side. However, the winds have to be in your sail. And that is the market. That is the trends. So when the winds come into the sail of a beautifully constructed boat, the boat actually starts moving. And that is the way to kind of put it. So that is really our process of risk management, that yes, we keep market caps within limits.
Right.
We have very disciplined exits. That is the ultimate risk control. However, we also feel that there is a need to be uncorrelated with indexes, because that is the only way you can actually beat the index. Because the index actually is one of the smartest created instruments. The ultimate trend follower is the index.
Finally, you've had 10 years with Rakesh ji.
Right.
Right. Who are the other market gurus that have influenced you apart from him?
Right.
And are there any good books on trend following that you would like to recommend to our viewers?
Sure. So Rakesh ji obviously was an influence, but I was telling you of this phase, when the whole IT bubble bust in 2000, and that is when I was looking around at what other tool do I need to have? How do I read the second half of my textbook, when to sell and how to sell? So I read this beautiful book called Market Wizards by Jack Schwager. I probably rate it as one of the best books on investing, and it's very easy because it's an interview format and it's very sort of chatty, and multiple people are interviewed. There I got introduced to one great hedge fund or a trader in the US called Ed Sykota. Very little known about him, and less so in 2000, okay? By 2000, you didn't have much internet, and phone calls had to be, you don't have this mobile stuff. So it was very difficult to connect with somebody overseas. So I was very influenced by Ed Sykota, and ultimately I didn't know where to find him, read anything about him. There was nothing. He was very secretive, okay? Very, very secretive, but very successful. Right. I liked about him was that not only was he very good theoretically, but he actually managed money. His returns that he has are like records even today, the kind of return profile that he had. So I started looking for Ed Sykota. I couldn't find him. Fortunately, in Bombay, I found 2-3 other people like me who were also very interested. And one of them had actually made a trip all the way to the US to just find this man.
Wow.
Right? And mind you, there's no internet, no GPS, nothing of that sort. So he had met Ed, and with Ed's blessings, we started something called a trading tribe in Mumbai of just 5 people.
Okay.
And we would meet every 15 days and actually work on our investing and trading styles based on the trend following philosophy of Ed Sykota. The tribe ran for years altogether, but I think Ed Sykota was one very enigmatic person. This book I've told you about, Market Wizards, is a phenomenal book. Actually, Jack Schwager went on to write 3-4 books after that. Right. And it's become multiple series. It's an inspiration for a lot of people to make a lot of series and podcasts. But the original book is Market Wizards by Jack Schwager, the first book. And there the person to follow is Ed Sykota. So I think he's had an influence. Later on, I was able to meet him in person.
Oh.
For the first time, Ed came out of the US and did a seminar at Cambridge in UK. And all of us, the full tribe in Bombay, we were just 5 of us, we flew all the way to Cambridge just to spend 3 days with him.
Wow.
And I think those were 3 very, very impressionable things. And that's where influences have come, life evolves and you meet wonderful people. But the beauty is a lovely journey. Yeah. And I think we are really blessed to be in a market that I consider the biggest trend in equities in the world.
Absolutely.
So that's one big takeaway for me.
On that positive note, we wish you all the very best.
Thanks.
Thank you so much.
Thank you guys. Thanks for being with us.
Thank you.